Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today's topic is cash flow statement. In previous sessions, we discussed about funds flow statement and what are the other types of financial statements. Based on that, the companies, how they used to analyze their financial status. So after going through this topic, the learner will be able to understand the concept of cash flow. Then what are the accounting standards for cash flow statements? So especially here we are going to discuss about AS3 and preparation of cash flow statement, importance and limitations of cash flow statement. So let us start with cash flow statement. So in financial accounting, a cash flow statement is also known as a statement of cash flows. It is a financial statement that shows how changes in balance sheet, accounts, and income affect cash and cash equivalents. And it breaks the analysis down to operating, investing, and financing activities. So cash flow statement, it gives information about cash receipts, which are known as sources of cash, and cash payments comes under application of cash. It contains opening balances, closing balances of cash for a given period, and explains how the closing balance as per last balance sheet changed by various inflows and outflows of cash to a closing balance of cash as per the next balance sheet. So, with the help of this cash flow statement, we can compare the inflows and outflows of cash based on the opening and closing balances of previous balance sheet with that of next balance sheet. As per AS3, cash would include cash in hand and savings, current account balances with banks and cash equivalents. So cash equivalents are short-term and highly liquid investments that are readily convertible into cash. An investment would normally be called a cash equivalent only when it has a short term maturity of, say, 3 months or less than from the date of acquisition. Coming to the analysis of cash flow statement, the cash flow statement is distinct from the income statement and balance sheet because it does not include the amount of future incoming and outgoing cash that has been recorded on credit. So it considers only cash and cash equivalent related transactions in the cash flow statement. Therefore, cash is not the same as net income, which on the income statement and balance sheet includes cash sales and sales made on credit. So, cash flow is determined by looking at three components by which cash enters and leaves a company. So, the sources and application of cash, it can be determined on the basis of core operations, investing, and financing. So, coming to operations, it includes measuring the cash inflows and outflows caused by core business operations. The operations component of cash flow reflects how much cash is generated from a company's products or services. So, generally, changes made in cash, accounts receivable, depreciation, inventory, and accounts payable are reflected in cash from operations. So, core operations means just by way of selling the goods and services. So, based on that, the company also generate cash. So, that is based on operations. The cash flow is calculated by making certain adjustments to net income by adding or subtracting differences in revenue, expenses, and credit transactions that are appearing on the balance sheet and income statement, which results from transactions that occur from one period to the next period. So, just by making some kind of adjustments in the net income, we used to compare one income statement and balance sheet from the other period. So these adjustments are made because Non-cash items are calculated into net income, which is derived from profit and loss account or income statement, and total assets and liabilities that we used to get from the balance sheet. So, because not all transactions involve actual cash items, many items have to be reevaluated when calculating cash flow from operations. So, second one is investing. So, changes in equipment, assets, or investments relate to cash from investing. In general, cash changes from investing are a cash out item because cash is used to buy new equipment, buildings, or short term assets such as marketable securities. However, when a company divers of an asset, the transaction is considered cash in for calculating cash from investing. The third one is financing. Changes in debt, loans, or dividends are accounted for in cash from financing. So, changes in cash from financing are cash in when capital is raised, they are cash out when dividends are paid. So, thus, if a company issues a bond to the public, the company receives cash financing. However, when interest is paid to bondholders, the company is reducing its cash. So, it depends how we are spending the cash on various activities. Based on that, we'll decide the financing of a particular company. Then coming to major cash inflows. So major cash inflows includes issue of new shares for cash, receipt of short-term and long-term loans from banks, financial institutions, etc. Sale of assets and investments, dividend and interest received, cash generated from operations. So these are all the major source of cash. Then coming to major cash outflows, which tells us the application. So redemption of preference shares, purchase of fixed assets or investments, repayment of long-term and short-term borrowings, decrease in deferred payment liabilities, loss from operations, payment of tax, dividend, etc. So these are the application of cash. Then coming to the classification of activities. So as per AS 3, the cash flow statement should report cash flows during the period which are classified by three types of activities. The first one is operating activities, second investing activities, third financing activities. So cash flow from operating activities. The cash flows generated from major revenue producing activities of the entities are covered under this head. Cash flow from operating activities is the indicator of the extent to which the operations of the enterprise have generated sufficient cash to maintain their operating capability to pay dividend, repayment of loans, and also to make new investments. So that should be depending on the cash flow from operating activities. So it is one type of indicator. And the main examples of this cash flow from operating activities are cash receipts from sale of goods and services, cash receipts from royalties, fees, commission, etc., cash payments to employees, cash payments or refunds, again, the receipt of income tax, cash receipts, and payments relating to future contracts, forward contract, etc. Cash receipts and payments arising from purchase and sale of trading securities. So that's how the company can generate cash from their operating activities. Then second one is cash from investing activities. So these are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. So this represent the extent to which the expenditures have been made for resources intended to generate future incomes and cash flows. Examples of cash from investing activities are cash payments for purchase of fixed assets, cash receipts from sale of fixed assets, cash payments for purchase of shares or debenture, etc. in other entities, loans and advances given to third parties, repayment of loans given, all these things comes under cash from investing activities. Then third activity is cash from financing activities. So financing activities are the activities that result in changes in the size and composition of the owner's capital and borrowings of the enterprise. So financing activities includes the debt and equity composition of a particular organization. So, separate disclosure is important because it is useful in predicting claims on future cash flows by providers of funds. For examples, cash receipts from issue of share capital, debentures, and short term and long term loans, and also cash receipt repayments of loans borrowed. So, if you are going to borrow loans, then the mode of repayment that which is done on the basis of cash, that is also comes under financing activity. Cash payment to redeem preference shares, so all those things comes under financing activities. Then let us go with the funds flow. Already we have seen where let us go with the cash flow from operating activities. What is the pro forma? What type of items that are going to be included in cash from operating activities? So cash from operating activities. So first we used to come with net profit before tax if profit and loss account is given. If not, it can be excluded. So in case closing balance minus opening balance, if profit and loss account balances are given in balance sheet, then that should be included here. For that, we have to add non-cash and non-operating expenses. So what items fall under this category? So where it includes depreciation on fixed assets, goodwill written off, preliminary expenses written off, discount on issue of shares and debentures, underwriting commission, cost of issue of shares and debentures written off, loss on sale of investments and fixed assets, foreign exchange loss, interest paid or dividend paid, loss by fire, theft, etc., proposed dividend, transfer to general reserve, debenture, and refund funds, etc., loss by fire, theft, etc. So these items come under non-cash and non-operating expenses. From that, we have to subtract non-cash and non-operating incomes. So which includes gain on sale of fixed assets and investments, interest and dividends received, any other extraordinary income, foreign exchange gain, all those things comes under non-cash and non-operating incomes. So for that we have to add increase in current liabilities. From that we have to subtract decrease in current liabilities. Then for that we have to add decrease in current assets. From that we have to subtract increase in current assets. Next, subtract income tax prior. So whatever we used to get, that amount is considered as cash from operating activities. Then second one is cash from investing activities. So what kind of activities we are going to consider under investment related activities? So it includes purchase of fixed assets and investments, sale of fixed assets and investments, interest received, dividend received. Then third type of activity is cash from financing activities. So which includes proceeds from issue of share capital, debentures, etc., proceeds from long-term borrowings, repayment of long-term borrowings, redemption of debentures and preference shares, interest paid, dividend paid. So everything comes under cash from financing activities. The next we have to find out the change in terms of cash, whether there is an increase or decrease. What is the net increase or net decrease in cash? So that should be find out, and from that we have to add opening balance at the beginning of period, closing balance at the end of the period. Then all the things we used to include here, the cash from operating activities, cash from investing activities, cash from financing activities, and net increase or decrease in cash by adding opening and closing balance. So, like how we used to prepare cash flow statement as an so and so date. Then coming to the benefits or importance of cash flow analysis. Efficient cash flow management. So with the help of cash flow analysis, the management can manage the cash resources in such a way that adequate cash is available for meeting the expenses. The second advantage is that internal financial management, which is useful for internal financial management as it provides clear picture of cash flows from operations. The knowledge of change in cash position. It enables the management to know about the causes of changes in cash position. Then comes success or failure of cash planning. So comparison of actual and budgeted cash flow helps the management to know the success or failure in cash management. Then it is a supplement to fund flow statement as cash is a part of fund. Next, cash flow statement is a better tool of analysis for short-term decisions. Whenever the company or the management, if they want to make any kind of decisions, then that should be done on the basis of cash flow statement so that they can able to understand what is the position of the sources and applications of cash in the organization. Then apart from these benefits or importance of cash analysis, it has certain limitations also. The first limitation is misleading inter-industry comparison. So cash flow does not measure the economic efficiency of one company in relation to another company. So within the same company, they may compare from one accounting period to other accounting period, but inter-industry comparison may not be possible with the help of cash flow statement. Then second one is misleading interfirm comparison. The terms and conditions of purchases and sales of different firms may not be the same. So as a result, interfirm comparison may also not possible with the help of cash flow analysis. Then third one is influence of management policies. So management policies influence the cash easily by making certain payments in advance or by postponing certain payments. So that's how the cash they used to influence the management policies based on the adequacy of the cash flow reserves. The company may make decisions. So it cannot be equated with income statement. So cash flow statement cannot be equated with income statement. Hence, net cash flow does not mean income of the business. So income of the business is different, whereas net cash flow is entirely different. Then cash flow statement cannot substitute the balance sheet and funds flow. So at it discloses only the cash and cash equivalents. So it never substitute balance sheet and also the funds flow statements. Then let us discuss accounting standard AS3 on cash flow statement. The objective of AS3 is to provide desired information about historical changes in cash and cash equivalents of an enterprise classified into operating, investing, and financing activities. So, an enterprise should disclose the components of cash and cash equivalents and should present a reconciliation of the amount in the cash statement with the equivalent items reported in the balance sheet. So, whenever the company they used to prepare the cash flow statement, they should consider both. They have to identify what are the cash related transactions and what are cash equivalents. So based on that, they have to report the equivalent items and everything in the balance sheet. So an enterprise should disclose the amount of cash and cash equivalent balance held by the enterprises that are not available for use by it with explanation of management, just for their own understanding of how much cash reserves are there in the organization and what are the various applications or uses of that cash, so that they can able to analyze with the help of cash flow statement. Now let us discuss about the difference between cash flow and funds flow. So let us take cash flow. Cash flow, it shows net change in position of cash and cash equivalents, whereas the same when you are talking about funds flow, it shows the net changes in position of working capital. So cash flow is prepared based on narrower concept of funds, that is cash and cash equivalents, whereas funds flow based on broader sense of funds where we used to take current assets and current liabilities, and that's how we used to find out working capital. Then third one is cash flow. If you take mandatory for all the listed companies and is more widely used in India and abroad, but whereas fund flow is not mandatory and not used by many companies. And coming to cash flow, classification of inflow and outflow is done in three categories. One is operating activities, second investing activities, and third one is financing activities. Whereas in case of fund flow, such a meaningful classification is not used in fund flow statement. Then coming to cash flow, no statement of changes in working capital is prepared as the changes are adjusted in ascertaining cash from operating activities. But whereas if you take fund flow statement, the statement of changes in working capital is prepared. Then coming to cash flow, increase in current assets, decrease in cash. Increase in current liabilities means increase in cash. Decrease in current assets indicates there is an increase in cash. Decrease in current liabilities represent decrease in cash. But whereas when you are taking funds flow statement, just quite reverse of that. Increase in current assets, it mentions there is an increase in working capital. Increase in current liabilities, it shows decrease in working capital. Decrease in current assets indicates decrease in working capital. Decrease in current liabilities, increase in working capital. So these are some of the major differences between cash flow statement and fund flow statement. Then let us take one example from the following information. Prepare cash flow statement for the year ended 31st 3 2014. So we have given opening balance, closing cash balance, decrease in debtors, increase in creditors, sale of fixed assets, redemption of debentures, and also net profit for the year. So using that information, now we are going to prepare cash flow statement for the year ended 31st March 2014. So as we know in cash flow statement, it includes three types of activities. One is cash from operating activities, cash from investing activities, cash flow from financing activities. Thereafter, we used to find out the net increase or decrease in cash or cash equivalent. So coming to the first one, cash from operating activities. So what kind of things that they are going to include in this? So as we know, we have net profit for the year, which is already given in the problem itself, 20,000. For that, we have to add decrease in current assets. So from where should we get means debtors is given. Debtors means inflow. This is the source from where the company can generate cash. So that amount has been given in the problem, that is 5,000, and for that we have to add increase in current liabilities. So current liabilities is treated as creditors. Again, this is also an inflow. So 5,000 plus 7,000, that is 12,000. 20 plus 12, 32,000. Then next we have to find out cash flow from investing activities. So there is only one investment activity given in the problem, that is nothing but sale of fixed assets. Again, it is inflow. The amount given is 20,000. The next, cash flow from financing activities. So redemption of debentures, this is outflow. That is the reason here we have taken minus, that should be subtracted. So you will get 50,000. Then total cash flows generated. So 50,000 minus the amount left over, that is total cash flows generated, is 2,000. Okay. Then for that we have to add opening cash balance, that is opening cash balance is 2,000. Opening cash balance is 10,000 opening cash balance, right? So for that, next we have to take closing balance. So how much the balance left over between the total and this one is considered as closing balance. So closing balance is 12,000. So if you take another example from the following information, prepare cash flow statement for the year ended 31st 3 2024 14 by direct method. So in this case, we have given cash collected from debtors during the year amounted to some amount, and cash paid to suppliers, and then paid for employees, furniture of the book value, and was sold for how much, what is the new furniture costing, debentures, interest on debentures, how much they charge, and dividend for the year ended, and everything furnished in this problem. So using this data, now we are going to prepare the cash flow statement. So which consists of, and a direct method, we are not going to divide the cash inflows as cash generated from operating activities, cash flow from financing activities, and cash flow from investing activities. Directly we make it into two parts. One is cash inflow and other is we are talking about cash outflows. So cash sales, cash collected from debtors, sale of furniture, opening cash balance, these are all comes under cash inflows. Then whereas coming to cash outflows, the data which is extracted from the above problem, that is cash paid to suppliers, paid to employees, purchase of furniture, interest on debentures paid, redemption of debentures, interest on redemption of debentures, then closing cash balance. So these denote cash outflows. So inflow and outflow both are same. Then let us take the cash inflows. 90 9,000 99 lakhs 20,400. From that we have to subtract cash outflows, which is 93 lakhs 97,470. Then the balance whatever we have, that is net cash flows. For that we have to add opening cash balance and closing cash balance. So this is the change in funds. There is an increase or decrease. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.